Today's session, just for those of you who weren't on a call that Nia and I hosted earlier this month, this is actually a follow-up call. The first call that we had was about the true costs of hard money. On that call, we talked about the fees and costs, both upfront and how to annualize them to help you compare your loan options side by side. So this call is meant to take your evaluation of hard money lenders one step further so that you can discuss and learn about key questions to ask not only yourself, but your lender prospects, just to elicit a little more qualitative information that you may not have thought about outside of a review of basic rate and terms and points. And I'll tell you, as a lender here in Washington State, that seems to be the first and sometimes the only question that I get asked when borrowers call in and ask to discuss their projects. And me and I feel that it's pretty important to go beyond those kind of questions and really understand what your own personal values and needs are and your project needs and what a lender can offer you. By the way, if you've missed our first call, you can find the recorded version online. And to accompany that, me and I also created a loan cost calculator that would help you be able to assess your lender options in a more apples to apples terms. And again, that would just be from the quantitative perspective: rates, fees, upfront costs, interest installments, and the such. So for those of you who attended our first webinar a couple weeks ago, you already learned a little bit about who Nia and I are. So I'll just give a really brief recap here. In a nutshell, both Nia and I, we grew up in Washington and we attended the University of Washington at different times. And then we started our careers out in the tech and telecom industry. On the side, we moonlit as investors, started out doing flips and then transitioned to buy and hold. And for Nia, he's investing quite a bit out of state, but for me personally, my husband and I, we like more local. I'm also, in addition to running Flynn Family Lending, I'm on the board of directors at the Rental Housing Association of Washington. So I'm pretty passionate about tenant landlord regulations in this state. And so I hold quite a few small multifamilies just in Washington State and haven't invested out of state yet. Our real estate investing side hustle then eventually turned into careers in financing. Me, as Lika mentioned, works at Certain Lending, and my husband and I run Flynn Family Lending. And you might think it's kind of unique that the two of us are hosting calls together in that we can potentially be viewed as competition, but that's really the impetus for these calls. We know that there's very specific niches and needs that each of our companies can support borrowers and real estate investors out there. And sometimes it's not an either or, sometimes it can be both. And so I've worked with Nia on quite a few deals. We pass them over the fence to each other, and in general, just try to do our best to accommodate our borrowers' best interests. The objective to today, as I mentioned, was to provide a little bit of guidance on how to effectively interview your hard money lender prospects beyond simple rates, terms, and fees. And again, if you were on our call earlier this month, you've seen this slide before. But what we really wanted to call out is that there are so many more details that you need to be aware of when calling down on a lender. A lot of borrowers, like I said, seem to call us overly concerned about rates and terms, that they don't often ask about other details that would help them ferret out who the best lender is for their particular project or need at the time. So I'm always hit up on how many points do you charge, what's your rates and terms. And from there, we get a few questions around the length of terms and loan to value, but typically the extent of that's the extent of what's being asked. And so there's so much more to investigate when it comes to taking on a bridge loan. Not asking the right questions around these key considerations on this slide can not only delay your financing, but it could increase the funds required from you out of pocket and or reduce your overall profit margins. So we'll just pause really quickly and do a quick poll. The first question is, how many of you have ever experienced the following with regards to hard money? And then the second question is, what matters most to you when seeking out a hard money loan? So for how many of you have ever experienced the following in regards to hard money, looks like the biggest there is that the lender requires you to bring cash to close. That's higher than originally told. And then for what matters most to you, seems like what's edging out down payment and funds to close and rates would be flexibility with creative financing strategies. So I think from these poll results, you can tell that quite a few people have experienced a number of different issues that could impact the timing and the financing of their projects. And so that's what we wanted to discuss here with questions that you really need to ask your lenders when you're calling down on them. And hopefully you're interviewing more than one to figure out what's right for you. So as an asset-based lender, hard money isn't just about the hard asset, although we do take a look at that. But other factors that we want to take into consideration as a lender would be the 4 C's: credit, character, cash, and collateral. And so as much as we look at your borrower profile from a lender perspective, you too should be interviewing your current status and your needs as a borrower. So for example, some, not all lenders, have credit thresholds. And in some cases, they have minimum barriers. I know that certain lending at times has had some minimum barriers, and so that's why sometimes he'll kick them over to us. My company doesn't necessarily care about credit. But then in other cases, your credit score can get you better rates and terms. So knowing where you stand in terms of credit can help you determine which lender is going to be the best fit for you. So a couple tips that me and I had were, one, you can sign up for Credit Karma. It's free, and they pull from 2 bureaus. The other option would be if you are a Bank of America credit card holder, they actually provide you your free FICO score. But just to baseline it, some credit thresholds are usually, a minimum of 660 for minimum credit thresholds, although there definitely are outliers. And like I said, that's not something that we take into consideration. Not all lenders will run credit. And then nowadays, 700 plus is kind of an important number to me as well. And then you're really going to get your best rates if you have 740 or better. So also understanding your personal background is important. This is what lenders sometimes refer to as character. Some lenders won't lend to individuals who have had a criminal past or who have filed a bankruptcy. And you really need to be aware if you have any current or historical liens, whether that's mechanical liens, IRS liens, judgments, unpaid taxes, current litigation, that will appear on title. All the lenders I partner with, including us, have required title insurance in the form of a lender's policy to go with your loan. So when we run that title report, these items are going to appear. And misinformation or not being upfront about this or not being aware of it can really kill the deal or set you back in terms of your closing timelines. So it's really important to address or at least be aware so that you can share out some of that information when they ask you to. Another key consideration is your cash position, especially during COVID. Cash reserves are kind of a newer requirement that have crept up, and they're even a requirement for quite a few conventional lenders as well for even a rate and term refi. So knowing the max amount of funds you have access to play with, either for your down payment, your rehab, carrying costs, or cash reserves you might need to have in place just so that you can refi. So if it's a BRRRR that you're working on, you really need to make sure that the lender that you're going to refinance out of, you have those cash reserves, which in some local credit unions that I've called down on, it can be as little as 4 to 6 months cash reserves, PITI, or it can be up to 12 months depending on your credit score. So knowing how much money you have to play with on your project is really important as well. And then under collateral, or in here I think I have business and project strategy, you should be thinking about your property value, both as is and after repair, or ARV. And you should take time to collect your experience for your lenders. Again, if you're going to go work with, in particular, some national lenders and some regional, knowing and sharing your past experience in projects is going to be important and will help determine some of your rates. But then also having a schedule of real estate. So some portfolio lenders, including my company, will help cross-collateralize and reduce your cash out of pocket. So it's important to have your schedule of real estate ready and know what your current balance owing is and what you perceive to be your equity in there, so you can share that out with your lender too. So those are some questions that you should be asking yourself and gathering. Again, each situation, each person is going to have a little bit different perspective on what they need from a lender. And it's really important for you to start prioritizing or stack ranking what matters most to you so that you can ask the right questions. And I'll pass it over to Nita to talk through the interview guide that we've put together. But it's important to figure out what matters most to you before you start making those phone calls to your hard money lender prospects. So with that, I'll turn it over to you, Nee.
Awesome. Thanks, Beth. So moving on, this is where, we're going to get right into the meat of it. When you're talking to a new hard money lender, most of the time you're talking to a sales rep whose job is to, number one, convince you that they are the best lender for all of your needs. And then number two, get your loan into their pipeline where it's going to hopefully close, right? But unfortunately, so many of these loans die at the last minute, or you can get bait and switched days before closing, and then you have no choice but to take the higher loan cost so that you don't lose the deal and your earnest money and ultimately your reputation as a real estate investor. So how do we avoid these situations? How do you tell whether a hard money lender is a good one? How can you tell what the true cost of the loan is? And the answer is basically in how you ask the questions when you're talking to a lender. So let's dive into that. So that first one, are you a lender or are you a broker? A broker is someone who doesn't fund your loan directly, but shops you around to multiple lenders to get the best deal for you. So the broker can actually save you time because they have all these contacts and relationships with lenders and be able to get you into a loan if you have let's say a complex loan scenario, right? Or if if your financials are tough, if the deal is tough, they have a better shot at getting you those because of their relationships and connections. But do know that the broker does add their fee on top, and that broker also doesn't have much control over the underwriting process. And another thing too is that commercial or hard money brokers are also very different than mortgage brokers, and that most of them are not actually required to have a license. The next question, what would you say is your most competitive advantage? I usually ask this at the end of an interview, but it doesn't hurt to ask it up front because it actually saves you time, right? You might decide that they're not really worth talking to right after this question. And a good lender, I would say, needs to be aware of the market, their competition, and where they stand in it. So the next one, what's your typical closing time frame? So I would say most hard money lenders can actually close within 2 weeks, even the national ones. I would say 3 weeks at the most, but once you start hitting 3 weeks or more, then you're getting to the point where you're kind of losing a competitive advantage over, let's say, conventional loan buyers because they can move that fast too, close in 3 to 4 weeks. Asking this question also gives you an idea of whether a lender is local or they're national, right? Because most local lenders can actually close within a week. Can I get a pre-qual letter or a proof of funds letter from you? A lot of newer investors go to a lender asking for this, or most people always ask, hey, does the deal come first or does a lender come first? And I always say you should talk to a lender first and foremost, even if they don't offer a proof of funds letter. Not all lenders do offer one, but most do, right? And I would say still I'll talk to a lender first before you even take on a deal, because then you have an idea of what kind of terms and what kind of requirements you're being subjected to, right? And which also helps you structure the deal. If they are giving you a proof of funds letter, they shouldn't be charging you for it. So be careful if anyone's asking you to put up some money, even like $20 for one, because you can usually get that for free in most other places.
Hey, Nee, what's your turnaround time for a proof of funds letter?
I would say usually within 24 hours. Most lenders are like that too. Oh, and to also ask what it takes to get a proof of funds letter. Some lenders, they do more qualification than others. In the end, a letter is a letter that you give it to the seller when you make an offer, right? So a lot of lenders, they offer this thing called a line of credit. We all know what a line of credit is in the banking world. It's usually like in the form of a HELOC, right? They put a lien on the property and they say, hey, you can use this like a credit card. You can draw on it, you can pay it down and keep using it, right? In the hard money world, a line of credit actually means more like a pre-approval, because you actually can't draw from a line anytime you want. You still need to identify property. You still need to put a down payment in. And so to a lot of these lenders, when they're advertising a line of credit, just keep that in mind, is that it's a pre-approval. It's a very strong pre-approval. It allows them to move faster, but it's not the same thing as a line of credit that we're used to in the banking world. For this next section about the loan programs, keep in mind that, if you can find a lot of these information on a lender's website, if they have one, but if they don't have a web presence and you don't know who the loan officer is, just be careful and tread carefully, because again, there are a lot of scammers out there. What are your minimum and maximum loan amounts? So I see more people running into loan minimums than maximums. And oftentimes, if you hit that maximum, you can sometimes get an exception to go above it. But if you're looking to buy in the Midwest or in a rural area, that loan minimum is going to kind of be more of a problem for you. So I would say anything less than $100,000, you're probably cutting out half of your potential lenders that you can work with, right? Less than $75,000 is another half. And then I rarely see a lender go lower than $50,000. If a loan is $100,000, that means the property needs to be worth, I would say probably at least 125, 130, right? Because lenders are lending at a lower percentage of the value of a property. They don't lend 100%. If a lender is saying minimum loan amount is $100,000, and let me just do quick math, and they lend at, let's say 80% of the value, right? That means that your value has to be at least 125. When you have a loan less than $100,000, it's going to be a very expensive loan. And that's because most lenders start charging a flat minimum fee versus like a variable percentage of points. The lower the loan amount, the more expensive the loan tends to get. So this next question, how long of a loan do you provide? So a lot of lenders in Washington state offer 6-month loan terms. The standard loan term for national lenders is usually 12 months. But I've also seen, 3 months, 9 months, 15 months, 18 months, some kind of multiple of 3, right? Although we do have a big lender here that lends in 5-month terms. So hard money, you can usually get up to 2 years. You might have to pay more for a longer term, right? Once you get past 2 years, it's a little bit harder, and you should really be asking yourself, why do you want to pay hard money, the high rates for that long? And I would actually encourage you to seek other kinds of financing first before asking for like a 3-year hard money loan. There's probably times where it is valid, but I would say you might have other options there. Okay, so this next question, as I mentioned, where do you lend? Do you care about rural areas, tertiary markets? This basically tells you if you're dealing with a national lender or a local lender. And know that just because a lender lends in a state doesn't mean that they lend in all parts of that state. So a lot of national lenders tend to stay away from rural areas and just kind of focus on major metropolitan areas. So if you are using a national lender in Washington state, it might be hard to get a loan in Aberdeen, Wenatchee, Yakima, or even Bremerton sometimes, because all those are outside that the greater Seattle metro area. Local lenders tend to be more comfortable in these smaller pockets within the state. So just keep that in mind. And okay, so next question, what asset classes do you lend on? Most people looking for hard money are just mainly doing residential flips or burrs, but it's also nice to know if they do other loans like multifamily bridge, new construction. That way you kind of know, okay, what can I come to this lender for? And then that last question, if you are a foreign national, or if you have a self-directed IRA or solo 401k and you want to get a hard money loan, you're going to need a non-recourse loan. And what that basically means is that you can't or won't sign a personal guarantee. If this applies to you, just keep in mind that terms are generally worse for non-recourse loans, right? Because it's not a safer lender. So you can expect a more expensive rate, perhaps more fees, points, and also higher down payment requirements, maybe 40 to 50%. So we're not actually going to talk about rates and fees too much, just because we did a whole webinar presentation on that last month. And we also gave you a calculator to calculate those costs as well. So I would check out that video.
One thing I want to point out, especially from some of the questions that Nee was just talking about in terms of what asset class they lend on, where lenders will lend, what their average terms are, and these rates and fees, they can all be found on most reputable lenders' websites. So in addition to asking yourself and prepping for these calls about what you need, you can also educate yourself on the baseline of what that lender offers and where through their website first. And that way you're going to be a little bit more informed when you start those conversations. So I would encourage people to check lenders' websites first before they start asking some of these questions too.
Yeah, and that way you have an idea of where to kind of start the conversation, right? I tell you, lenders rarely list points on their websites or fees. They really mainly just play with rates, right? But they also never answer the question of like what actually affects the rate, or what makes the rate differ. They either say, hey, we have rates starting at a very low number that most people can't get, or they give you a range, right? I would say that most hard money rates range from 7 to 15%. And so the lower end of that is usually on the West Coast, and the higher end is usually in the Midwest or places where loan amounts are pretty small. During COVID these days, it's hard to get below 9% on the West Coast. Still doable, but it's getting much harder, and terms have changed almost dramatically, right? Rates are also generally affected by, number one, how much down payment you're putting in, so what LTV they're lending at, right? Your experience, and then your credit scores sometimes. For points, I've seen 1 to 5%. Also, again, keeping in mind the lower end usually means West Coast, and the higher end is the Midwest or smaller loans. These days, in the last 4 months during COVID, it's been getting hard to get under 2 points. Most lenders are starting at 2 points. And keep in mind that, as I mentioned before, most lenders have a minimum origination charge for the lower loan amounts. So if you want an example, right? Let's say a lender normally charges 3 points, but they also have a minimum fee of $3,000. $3,000 for a $100,000 loan is 3%, so it matches that points evenly. But $3,000 for a $50,000 loan is 6%. So that's why I said that smaller loans can actually get pretty costly with the fixed fees. Points are usually affected by experience and how long the loan is. If you want a longer loan, it usually costs a little bit more. When it comes to fees, and there's many different names for fees. A lender might call it an application fee, a processing fee, an underwriting fee, an admin fee, a service fee, an appraisal or BPO fee, even a rehab fee, right? A legal fee, an attorney fee. Like, you actually start seeing that more as you invest out of state. Every single hard money lender, when you talk to them, they'll advertise their points and rates, but no one talks about fees. And this can be pretty important because I've seen lenders charge as much as $5,000 on top of points, just in fees. And of course, I've seen them charge nothing but points, right? No fees. The typical fee that you see for most hard money lenders is somewhere between $1,000 and $2,000, not including the appraisal. So when you're comparing lenders, right, add all the points and all the fees together, and then that's your total cost. Right? It's the same reason that you compare APR, not interest rate, when you are comparing conventional loans. Be careful about paying any fees up front. And so most of the time, the only fee that you should be paying up front is the appraisal. Otherwise, just really make sure that the person you're dealing with is a real lender and not a scam artist, right? Because a lot of scams, they'll say, hey, pay me $250 up front to take your application, and then we'll get it started, and then you never hear back from them again. So just be careful on that. Prepayment penalties and interest guarantees. Hard money loans, as you know, are generally intended to be very short term. So most lenders don't have prepayment penalties, which is essentially a penalty or fee for paying off the loan too early, right? Let's say you have a very cosmetic flip that takes 2 weeks to rehab, and you put it back in the market and you sell it from close to close within 2 months, right? That's a pretty short loan. I don't really see prepayment penalties that much. What I see a little more often, but again, that's not very common, is something called an interest guarantee, which guarantees a lender a certain number of interest payments no matter how early you pay it off. If you have a 1-year loan with a 4-month interest guarantee, and you happen to pay off the loan in 2 months, then you're still paying interest for 4 months, right? Corey commented in the chat that rentals much more likely have prepayment penalties. So most commercial rental loans have prepayment penalties. In the scope of hard money, you don't see that as often.
Hey, Nee, how much is a prepayment penalty, generally speaking?
Again, I don't see it very much in hard money. I would say maybe a point if you come across to it. In the commercial loan, you see usually like 5 or 3-year prepayment penalties, and that might be a flat fee like 3% if you paid off any time within 3 years, or a 3-2-1, which basically means that you're paying 3% that first year, 2% the second year, and 1% if you pay it off within the third year. So extensions. We're talking about worst case scenarios here, right? So what happens if you're in a loan longer than what its term is? It's always better to ask these questions up front than to come against it when you're in the loan. If you plan for things up front well, you can just always take a longer term, and the cost to pay for a longer term up front will be minimal compared to the extension fees that you have when you're coming up against the deadline. Okay, so basically plan ahead. Most national lenders tend to charge like a point for every 3 months on average, whereas local lenders can be as expensive as 1 point per month. If you're paying 12% and then also 1 point per month extension fee, that's a 24% rate, right? That's 2 points per month. Note that you can't extend forever. Most lenders have some kind of cutoff, and you're eventually going to get to a point where lender will say no more and start just charging default rates or even foreclosing, right? And keep in mind that not every lender offers extensions. And so really plan ahead. If you decide not to take an extension, either because the lender doesn't allow extensions or because you're already on pace to pay off the loan, like you have it under contract to sell and it's going to close within 2 weeks, and you don't think it's worth it to pay the entire point for however long, right? Then you can just take the default rate. But keep in mind that default rates are usually, I've seen most common is actually 24% in the hard money world. So again, that's 2 points per month. And default rates can also apply if you have a late payment. I kind of really want to stress on this because I find that most investors are very optimistic and don't think they'll need more than 5 to 6 months to do a flip. you have to really recognize that you're not in control of everything. If anything, if you look at the vast things that can happen, you're not in control of most things. The most common issues you see are contractor issues, right? Where, you're getting delayed on projects because your contractor slows things down. But, what happens if the market changes, right? And, we're so used to this market incline of appreciation that even a flattening out of the market can just change how long properties sit on the market. I had a flip that was supposed to take, 6 to 8 months, ended up taking 2.5 years, right? It's another story for another day. And then I also had another flip where, right when we listed it, a huge sign came up across the street and it said, "Tent City is coming to you," right? Who would have thought that the empty lot across the street from our property would be used to house homeless people? So that house sat for a while because no buyers wanted to live across the homeless encampment. And
I
so,
actually have a funny story on that, Nee, because Nee stole that deal from me. I could have ended up with that deal, but luckily he went in there and got the deal before me, and I didn't end up doing it. He got stuck with it.
this is news to me. I didn't know that. Yeah, I mean, because of stories like that, and because obviously having personal experience, I always get a 1-year loan now, even for a 2-week cosmetic flip.
COVID right now is a perfect example of that, right, Nee? I mean, how many
Yeah.
people got shut down for a couple of months? We had a borrower who was ready for their electrical and plumbing sign off on a new construction, and they already had it pre-sold. And the day that the inspector was supposed to come, the city shut down. And it would have been nice to get that electrical sign off so that they could just drywall and keep moving kind of secretly from there, but they couldn't for about 2.5 months. So things happen. And then prior to that, in 2018, that kind of happened towards midterm elections as well. And then flowing into the holidays, and then in Washington, it's snowstorms. So you just never know.
What if you need to do an eviction, right? Like in this example, if you're buying houses at the auction, I would say about half of them come with someone that you have to kick out. And that eviction process can take a while. And if you have a 5-month loan from, a popular lender, I don't see how you can kick someone out, do the renovations, and put it on sale within 5 months. If you happen to buy a property with a tenant and then COVID hit, you're not getting evictions for a long time. Again, a lot of these things are out of our control, right? Just plan for worst cases always. So that last question here, do you charge interest on the entire loan amount at all times, which is what we call Dutch interest, or do you only charge interest on drawn funds? When you have rehab funds being borrowed, lenders put this money in a holdback account and then disperse it to you in draws, which we'll talk about later. In an ideal world, you are not charged for this money because it's not sitting in your bank account, right? Like why should you be charged for money that you can't use? So when you don't get charged money on these rehab funds, that's called non-Dutch interest. But a lot of lenders nowadays actually will charge you money on the entire funds, the entire loan amount, whether or not you've drawn from that holdback account. And it sounds kind of scammy, but it's actually pretty common. And this is because, again, we just said that why should I be charged for money that I'm not using, that I can't touch, right? Well, a lot of lenders set that money aside for you, so they don't have access to it either, right? And because they set that money aside, they're charging you interest on it. When COVID happened back in March, and a lot of lenders lost their liquidity, and some of them even froze draws, which means that you couldn't get a draw. Even if your project progressed, you can't get money to reimburse yourself. A lot of borrowers were very upset. This tended to happen more with the lenders that didn't charge Dutch interest because some of them didn't set that money aside. Lenders that charge Dutch interest tend to have easier draw processes and have that money set aside for you. So pros and cons, right? Looking at the comments, Michael mentioned an exit fee. An exit fee to me usually is like a point, right? Some lenders will say, I'm going to charge you 2 points, 1 point up front, 1 point at the end. And we call that an exit fee. That doesn't happen too often though. Loan structure and loan restrictions. These questions that you're asking is a really good way to kill the conversation you're having with a lender, because if they can't do something that you really need to do, that kind of saves you time, right? It's like, I don't need to talk to you anymore. We're not going to work together, right? How much will you lend of the purchase price of the rehab and of the ARV? So most of the times you're borrowing hard money, again, to fix up a property. And usually there's a rehab component and then there's a future value, an ARV, or after repair value. Lenders will either lend separate percentages on the purchase and rehab, like 80% of purchase, 100% of rehab, or they'll lend based on a loan to cost structure, and cost in their eyes means purchase plus rehab. And if they're lending on a loan to cost, they're lending on the same percentage to both purchase and rehab. So let's say 80 purchase, 80 rehab. Keep in mind though that a lot of lenders that lend on a loan to cost basis, like the same percentage on purchase and rehab, are still lending 100% of the rehab to you, So if a lender is lending 80% loan of cost, that means you're putting your down payment is 20% of cost. So that's 20% of both purchase and rehab. What they do is they essentially take that down payment that you put on the rehab, and now they have 100% of the rehab set aside for you, right? Because they provide 80 and you provided the 20. That makes it a lot easier for the draw process. And it just makes sense because now you actually have money to complete the project set aside. So this gets pretty complicated because we're essentially talking about LTVs, and I plan on doing a 10-minute video on what LTV means and how it can mean different things in different ways and how can it affect your down payment. So watch out for that in a couple of weeks. I don't want to spend a fourth of this presentation talking about it. What I want you to take away from this question is never ask what LTV the lender is going to lend to you at. Always ask how much you will lend a purchase price, of rehab, and ARV. Because when you start mentioning the word LTV, what you think LTV is and what the lender might present LTV as usually doesn't match. And you're going to be surprised when they ask you to put in a higher down payment than what you thought. A lot of lenders just ask this question: how much of the ARV will you lend on? And usually newer investors, right? And they say, okay, cool, you lend on 70 or 75% of the ARV. And then your deal is exactly 75% of ARV. And you're like, oh, cool, I'm going to get 100% financing. The answer to this is a big fat no. So 95% of lenders require down payment. The other 5% lend in Texas or a couple other places, right? Texas has some interesting things where they do 100% financing, but you'll pay for it. Interest reserves are essentially money that's set aside to make your interest payments. So they're becoming more and more popular with lenders during this COVID time because of all the forbearances and the COVID cash flow implications that we're seeing. Oftentimes, if a lender is asking for an interest reserve, they want you basically money set aside for 6 months to pay the interest. So you don't have to make payments for 6 months. That money is automatically going to pay it for you. So it's like another holdback, right? Sometimes they make you do it for the entire loan term. So if it's a 12-month loan, they might have a holdback for 12 months of interest payments. And it's usually you who has to fund that interest reserve, which sucks because that means you're essentially putting in more money, essentially a higher down payment, right? If you have a 10% rate and you're having to put down 12 months of interest upfront, that's like putting another 10% down. I've also seen lenders say, okay, you make the first 3 payments upfront and then we'll fund the other 9 months or something like that. If a lender is funding your interest reserves, ask if they're charging you points on interest on your interest, okay? Because if it's something that's added to the loan amount, then they just always charge points on interest on the entire loan amount. Sometimes they're rolling it into the loan instead of saying it just as a separate bucket. And it could lower your LTV ratios, which means that, again, you're putting in a higher down payment because they're requiring an interest reserve. Do you require vesting in an entity? A lot of people on bigger pockets complain that their lender requires them to get an LLC or some other entity in order to borrow hard money. And this is most often a lender requirement, not necessarily a requirement in general. There are some states like Florida, North Carolina, New Jersey, Ohio, and Virginia that do require you to borrow money in an LLC when it comes to hard money loans, but most states don't require it. And so it's generally a lender requirement. If you really want to borrow money in your own personal name, like if you're in a BRRRR and you want to do a cash out refinance or a conventional loan afterwards, and your lender is telling you that you need to get an LLC, just find another lender. Do you allow junior liens behind you? If you work with private money and private lenders, right, and you plan on giving them a deed of trust or a mortgage, you might want to check with your hard money lender to see if they'll allow you to record a second or even third or more liens behind them at closing. And most national lenders tend to be picky about this. They won't allow it. And it's mainly because a lot of these lenders resell their loan after closing and their loan buyers won't accept it. This really can limit your ability to do creative deals with private money and also even like seller financing, because that is private money. Will you allow me to cross-collateralize my down payment? If you have equity in another, preferably free and clear property, some lenders will let you use that equity instead of having to put in a down payment. And so they'll put a lien on both houses to feel safe about waiving that down payment for you. So this is called cross-collateralization. And it's another wonderful way to be creative. But some lenders can only put one loan on one property. That doesn't mean you can't get cash out on one property in order to pay for a down payment for the other one. But when you have separate transactions or separate loans, it can be more costly. So just keep that in mind. Do you allow assignment fees to be included in the loan amount? If you are a wholesaler or if you're an investor that buy from off-market wholesale properties, you have to ask this question, okay? Most newer investors and wholesalers don't realize that some hard money lenders will not finance an assignment fee, which means that the borrower will have to pay that entire fee out of pocket, which can kill the deal depending on how large that fee is. Most lenders that do finance the fee will only do it up to a certain percentage of the purchase price. So for example, if you have a $30,000 assignment fee on a $200,000 purchase, they're only going to count 10% of $200,000, so $20,000 towards your basis to get your loan. That means the borrower has to come up with that extra $10,000 out of pocket. If you're in the Midwest, this is more of a problem, right? Because with smaller loan amounts, like $10,000 can do a lot of damage on a $50,000 loan or even $20,000 loan than a $200,000 loan. I had a deal in Kentucky where it was a $22,000 purchase, but the wholesaler was putting an $18,000 wholesale fee on it. That's almost like 100% wholesale fee. I didn't mind because it was still a deal, right? But of course, my lender minded. So also, when you're approaching a lender to fund a wholesale deal, just be upfront with them that there is an assignment fee involved and how much it is. So when you present the deal to them, don't just say, here's my acquisition cost and here's my rehab cost. Actually break down the purchase price and assignment fee and then let them have a run with it and see what they tell you. It's going to save you a lot of time, headaches, and unwelcome surprises at the closing table by saying that upfront. There are different ways of wholesaling. I think most of us are familiar with assignment fees, and this is not very common in Washington state, but in other states, they do double closings. Or a wholesaler has a property locked up in an entity, and then they sell you that entity. That's another form of wholesaling. If you're doing that for the deal that you have, just make sure you mention that to lenders, see if there's any problems. Again, double closings, you don't see that here in Washington that much because we have a transfer or excise tax. So it makes it costly to do that. But they are common in places like Indiana and Texas. So ask your lender if you can do them. And not only that, but what documents are required from the wholesaler to get the loan through. And this is important because if you are doing a double closing, there are lenders out there that require seeing the original purchase agreement between the wholesaler and the seller in order to do the loan. And a lot of wholesalers are very reluctant to show that agreement because they don't want people to know how much they're making. Sometimes the reason why you do a double close is that no one knows how much you're making, at least until they check title. So credit is a big topic. Most lenders check your credit, and most lenders have a minimum credit score that they can lend on. So I've seen as low as 550 or 600 before COVID, but nowadays anything under 660 is rare. Some lenders are only going to do loans to borrowers in the 700s. There are lenders who don't have any kind of minimum score, and they're generally the ones who are local, who don't care about credit, and they don't even check for it. Beth mentioned Credit Karma. Just keep in mind that Credit Karma doesn't show you the actual credit scores that a lender is seeing. I mean, most online see your FICO score for free programs don't show the right FICO scores. There's a lot of different FICO scores, and lenders use a specific one. I actually subscribe to something called My FICO. I pay for it, and I get a very extensive credit report with multiple scores each quarter. The credit report is like over 100 pages, right? Because they're showing multiple scores in all the accounts and just a lot more information than anyone needs to know. In the past, some lenders have accepted that in lieu of doing their own credit pull, but I don't really see that as often anymore, but it doesn't hurt to ask it. I am starting to see more lenders doing soft credit pulls instead of hard pulls, which means that it's not going to show up your credit and it's not going to hurt your score. These usually come from a more tech-savvy lender. The how often will you pull my credit is kind of like if I come back to you and we do multiple loans together. If I do it within a 3-month period, you're fine. If it's 6 months or 12 months, I might need to do another credit pull, right? So ask the lender what their policy is, how long they can use that credit for. The next part is experience. So experience is another big deal for lenders, and it's usually how you can get the best terms from a hard money lender. Most lenders will finance brand new investors, but less so now during COVID than before. The tricky part is how are they going to consider experience and what exactly do you need to show? Most lenders ask how many deals you've done in the past 2 years, but what does deals mean, right? Ask them if BRRRRs and refinances out of hard money count as a deal, or if they only count flips. Sometimes they count the number of rental properties you have, which is nice. There's a national lender that says you must have purchased and sold within the past 2 years, not just sold. This is the same lender that's going to ask you for a HUD to prove each purchase and sale. So their highest experience tier is 24 deals to get the best rates, and that means you have to show 48 HUDs to prove that. Yikes, right? Most lenders just ask for real estate schedule or resume, or they have a sheet that you fill out and they will look it up in public records. So the more tech savvy the lender is, the less they'll ask. Underwriting. Most common things you need to submit for a hard money loan are bank statements, entity docs, purchase contracts, scope of work, maybe a real estate resume, and some form of application. Some lenders require tax returns or personal financial statements. Most lenders don't ask for that for a short-term bridge loan. And I don't know any lenders, hard money lenders, that require pay stubs or income verification. I felt a need to say that because I have a lot of people asking whether or not they can get a hard money loan if they don't have a job. So hard money doesn't care if you have stable income coming in. They just care about how much money you have in the bank. Questions about partnerships. And so when you have partners, it complicates things, especially when it comes to financing. A lot of lenders only require one person to qualify or personal guarantee and sign to close, but some lenders will require majority ownership or anyone who has at least 20% of an entity. So asking this question ahead of time allows you to structure your partnership. And if you have different partners with different roles, ask your lender if that's going to work. Like, oh, can you qualify this person for experience and this person for liquidity? Speaking of liquidity, this is a very hot topic. Most lenders will ask for 2 months of bank statements. And when I say a bank statement, I mean any kind of asset statements, whether it's your 401k statement, life insurance statement, etc. Ask the lender what they can consider as liquidity and what kind of reserves they'll need to see. HELOCs are a hot topic because a lot of borrowers use that as their primary source of capital to invest with. There are a decent amount of lenders that don't let you to use borrowed funds to invest. Sometimes they're okay with you moving that to a bank account and then showing them a bank statement because they don't care about seasoning or sourcing, but that's why you have to ask those questions too. Appraisals and valuations are another big topic because this is the primary differentiator between a local lender and a national lender. And the main reason why is that closing timeframes are longer when a lender requires a valuation. The national lenders that can close fast within a week that still require an appraisal are able to push the appraisal post-closing, which is interesting. But as long as they're comfortable with your experience and their desktop review of the property, they can close fast. If you don't know what a BPO is, it's a broker's price opinion. It's a valuation that's done by a realtor and not an appraiser. BPOs tend to be cheaper, but not necessarily faster than appraisals. Keep in mind, some lenders also require an inspector to come out and visit the property to verify your scope of work or the rehab on the project. Knowing this is very helpful because if an appraiser and an inspector need to come out, you need to tell your wholesaler or the seller that there's going to be multiple visits to the property and it's going to be a headache. So most flips require an ARV appraisal, which uses your scope of work to determine what the property is going to look like when you finish and then do comps based on that vision. But some lenders also care about as-is values from the appraisal, which means that if that value comes in lower than your purchase price, you're going to need to put in a higher down payment. Most lenders just basically go off ARV, but sometimes the as-is value can get you screwed too. There are also some lenders where they'll order an appraisal or BPO, and then internally they'll also decide to lower the value to be even more conservative, which again increases your down payment. Okay, so draw process. I can tell you that no one likes draws. No lender likes draws, no borrower likes draws. It's like being an offensive lineman in football. You never get praised for doing a good job, but you definitely hear it when you do a slightly bad one. Ask the lender to give you an overview of the draw process. Most draws have some kind of submission request and then a third-party inspection, and then they wire funds based on what the inspection says that you've completed of the project. Ask if you need to submit invoices and receipts and lien waivers, or how much, like over a certain threshold, especially if you're doing the work yourself and not hiring a GC. Most lenders will reimburse you for work that was completed and paid for. If you order materials and leave them in the garage, that's not completed, right? And if you have work done but you didn't pay the GC, that means you can't produce receipts or lien waivers. Again, ask if this is required from the lender as part of the draw process. There are some pretty easy draws. I've seen like take current pictures, send it over, and we'll wire you funds within 24 hours. Most lenders tend to turn around a draw in about a week. There are also lenders who are more tech savvy who are doing virtual inspections now, which saves you both time because you don't need a third-party inspector to come out, and then money too because there's less draw fees because of that. Most draw fees are somewhere between $150 and $250, and sometimes this is collected upfront versus per draw. And then last but not least, ask about upfront draws. This is somewhat rare, but because most lenders reimburse you for draws, but some lenders are using it as like a competitive advantage, which means that when you close, you get a draw right away without having to do any work. And it sounds nice, but then ask them, what amount they'll fund up front or what percentage of the draw will be, and then what that last draw is going to look like. Ask if you're always going to be fronted the money, meaning that when you're about 80% done of the rehab, you've already gotten all the money. If they're fronting the first draw and they still make you finish everything before they fund the last draw, there's no point because at some point you need to put in more money than you thought. And then be careful how they structure the loan in comparison to the upfront disbursement. If they're making you put 25% down and they're funding 20% of the rehab upfront, that might be the same thing as you putting in 15 to 20% down and then using the money you're saving from a lower down payment and then starting the rehab and ask for reimbursement later. So some lenders can make it look like a competitive advantage when it really means that it's not any better if you just go to a lender with a lower down payment requirement. well, here's our information. Feel free to sync up with us anytime. And we also wanted to post out a guide.
Well, the nice thing, it'll be a list of all the questions that me and I recapped for you here, but also a blurb on the value or the importance of asking that question and the type of response that you're looking for, and the information you're trying to get from the lender. So all of that will be embedded with the guide that we'll share out later too.
Any questions?
Thank you, Nee. That was awesome. I was packed with information. We do have a couple questions from Corey and Scott. What is the health of hard money lending right now? Because a lot of people stopped lending during COVID.
Yeah, and we talked about that in the previous webinar too, but it's getting better, right? It was pretty bad in April and May. June, lenders started coming back, programs started coming back. Most lenders are back to lending now. The only thing you see is that it's just not as cheap as it was before.
And the loan to values are lower too.
It's harder to get a loan in general because they have more requirements, like more down payments, higher credit score requirements, and then interest reserves maybe, and higher rates too.
And then we have a question from Seiko. She says, what is the average rate for non-recourse loan?
It kind of depends on what rate they're normally lending at. So I would say usually about 2 to 4% higher in the rate.